What's up, everybody? Welcome back to Toya Talks Real Estate. I am a licensed real estate agent in South Florida, and I'm here to help you navigate and understand all things real estate. And in today's video, we are going to talk about debt to income ratio. And debt to income ratio is so important when it comes to you and your buying power for your brand new home. Debt to income ratio will determine how much you get pre-approved for, and it will also open up your eyes to what you earn versus how much you pay in bills every month. So let's get into it. The debt to income ratio, or DTI as lenders would use, they are basically just comparing how much you earn every month versus how much you owe every month. Okay, so it's just a big picture. They take everything together of how much you earn and they divide that by your expenses, and then they get a percentage. They use that percentage to determine how much of a loan to give you for your mortgage. So the first step to determine what your DTI is to look at your income, and this will be your income before taxes. Okay, so in today's example, we are going to use the income of somebody who makes $5,000 a month. And for your debt, that refers to your rent, that would be your credit cards, that would be your student loans, that would be child support payments, that would be alimony, any reoccurring payments that you have every month. DTI, or the debt that is considering, will exclude any type of utilities, health insurance, food costs, miscellaneous expenses. It doesn't include that when a lender is calculating your debt when it comes to qualifying you for a mortgage. And when you're calculating your debt, remember, you're only using the minimum amount that's required for that reoccurring debt. So for instance, with your credit card payments, you may be throwing $200 or $150 a month at it, but your minimum payment is really only $50. So that's the amount, the $50, that's the amount that the lender is going to use when they're calculating your debt to income ratio. So what we're going to do is we're going to add up all of our monthly debt. Remember, the rent, your credit card, child support, alimony, student loans. We're going to add up all of those amounts, okay? And then we're going to see how much debt to income ratio, or DTI, would be for somebody who makes $5,000 a month. When it comes to calculating your debt to income ratio, or your DTI, they are going to use your reoccurring debt. And what do I mean by reoccurring debt? That includes your rent, that includes your credit card payments, that includes your car payments, student loans, child support, alimony. Any reoccurring debt that you have on a monthly basis must be included. For our example today, let's say that your rent is $1,700 a month, your car loan payment is $350 a month, your student loan is $250 a month, and your credit card bill is $150 a month. So when we add up all of those numbers, we come up with $2,450 a month. Now remind you, this does not include your food, doesn't include your light bill, it doesn't include any of that. So even when you are meeting with the lender, please be mindful when they give you a fee sheet or an estimated monthly mortgage, please factor in all of those other expenses that you will be paying for, and make sure that you are getting a home that you can afford. And that's why, as realtors, we encourage people to shop for something less than what you've been pre-approved for, not the max, because they're not factoring in all those other expenses that can get expensive. So now we're going to take $2,450 and we're going to divide that by $5,000. So remember, we're making $5,000 a month, and our total reoccurring debt is $2,450. So $2,450 divided by 5,000 gives us 49%. So now we know what our DTI is, or our debt to income ratio, and that is 49%, which is high. So most lenders want to keep you around 45% when it comes to qualifying you for a loan, your DTI. So that, some of them just might take 45% of your monthly income. They don't even count up your debt. But for the most part, they don't want to exceed that 50% mark. Okay, like FHA, they have it to where your DTI can go to 57%, I believe. And I think that VA allows you to go to 60%, but it's a very rare and it's a case-by-case basis. And the higher, of course, that your DTI goes, then you're going to limit yourself to a certain amount of loans that you'll qualify for. And those loans itself may have higher interest rates. So you see what I'm saying? So you may get the house that you want, even with the higher debt to income ratio, but you're going to be paying for it with a higher interest rate, and you're probably going to lose out on other benefits, such as you may have to use FHA instead of conventional now. And FHA has its, its cons versus a conventional loan. You may have higher interest rates, or you may not get, closing help with your closing costs depending on the lender. So you're just limiting yourself to the type of loans, and you don't want to do that. The lower your debt to income ratio, the better. Okay, that's going to significantly improve your chances of getting the home that you want and also getting approved for the most money. I'm going to also give you some tips on how to reduce your debt to income ratio so that you can prepare yourself to have more buying power. Also, when you're considering your debt to income ratio, there's no HOA included either. So when you start to go shopping, okay, that's going to be a big factor, especially here in South Florida where HOA is everywhere. You definitely want to leave that cushion. You may be pre-approved for $350,000, but you may not be pre-approved for $350,000 with the HOA. So it's very important, like I said, to reduce your debt to income ratio. And here are some tips to lower them. So paying down your debt is going to be one of your main goals. So paying off your credit cards, paying off your car payments, doing anything you can to get those payments down. I recently heard that they're going to start adding the afterpay. You know how you buy something online, you can buy something from a clothing store, you can buy wigs, you can buy all these different things online, Amazon, and then pay later. They're going to start adding that to your credit report. So that may be good for people who want to say, like, okay, that's showing that I'm paying on something, but that's also going to be added to your debt to income ratio. So if you're one of those people that have like all these different accounts open with all these different afterpay accounts and you're trying to buy a house, I would suggest that you take care of those afterpay accounts now, because when you go see a lender and it shows in your credit report, then that's going to increase your debt to income ratio from what would have been 30% to 50%, just depending on how much you got. And with paying down existing debt, I'm always an advocate of Dave Ramsey, or you can find any other financial expert that you vibe with, that you love their content. But of course, you can use the snowball method, which is paying down your highest debt first, or you can use the avalanche method, which would list your debt with the highest interest rate and paying that down first. It's totally up to you. You got to figure out what works best for you, but always the main goal is to pay down the debt. Don't ever try and spread yourself too thin. If you follow the snowball method, you're going to focus solely on paying down your highest debts. You're going to throw all your extra money on it while you pay the minimum on the other bills. So you're not necessarily stretching yourself and you're trying to pay, the most money on all these different bills at one time. That's not how it works. You're gonna run yourself thin, and that's not the goal. Okay, we want to work smarter, not harder. And to piggyback off of the snowball method, you're going to be paying more than the minimum. So say you're using a snowball method and you're going to be paying the highest debt that you have. You got that Macy's credit card, or you got that Victoria's Secret credit card. You're going to be throwing like that extra $200-300 that you have that you can play around with every month. You're going to be putting that on that $65 minimum payment towards that credit card. So now you're going to be paying that $265 or that $365. You're going to be paying that consistently until that debt goes down. Also, whatever you do, if you're trying to buy a home and you're trying to keep your debt to income ratio low, do not co-sign on a loan for anybody. because that's going to add to your debt because you've co-signed, right? So be mindful. If you have somebody who wants to get a car and they want you to co-sign, they got a house and they want you to co-sign, I can't tell you what to do per se. If you shouldn't or should not, I should take that back. I can't tell you what to do, but just be mindful that if you choose to make that decision, it's going to affect your debt to income ratio. It's going to affect your buying power. There are ways to get out of it. I believe that you have to show proof to the lender that you've never made a payment towards that account, even if you've co-signed on it. But why put yourself in that position to begin with? And with credit cards, closed mouths don't get fed, right? So why don't you call and ask them like, hey, can I get a lower interest rate? Even if they say no, it would have been the same interest rate had you not called. Just utilize your resources to do everything that you can to bring down either that monthly payment by paying more than the minimum, calling them and asking them to reduce that interest rate, or even just raising your income. You may have to get a second job for a few months, or get you a side hustle. Do whatever you can to pay down that debt, because the less debt that you have is going to give you more buying power when it comes to buying your house. And also for those people who have student loans, they take a certain percentage of your student loan debt and consider that into your debt to income ratio. So for instance, they used to take like 1% of your total student loan debt, but now they only take 0.5%. But if you have like a lot of student loan debt, like 100,000, they're already going to give you a bill of $500 towards your student loan balance. But what you could do is sign up to get on an income repayment plan, or you can consolidate the loan. You can take whatever measures that work better for you financially and in the long run, and one that you can commit to, and see if that option would reduce your monthly payment, and present that to the lender versus them just taking 0.5%. Because if your student loans are in deferment or in default, they automatically take the 0.5%. All right, guys, that's all I have for this video as it relates to debt to income ratio and how it affects your buying power when it comes to buying your first home. I thank you so much for you guys joining me. If you have any other questions, or if you want, or if you would like for me to go deeper on some of the things that I touched on in this video, please put them in the comments below so that I can make videos about them or elaborate more on them. I really want you guys to be educated and have the knowledge. Therefore, you will be able to move better in this real estate market, okay? I really want you guys to utilize your resources. Utilize these resources of YouTube and, just to read, pick up a book. We don't have to be put in a bad position, okay? We do not have to suffer long-term consequences if we just make the short-term sacrifices of educating ourselves, okay? So thank you again so much, and I look forward to seeing you guys in the next video. Thank you.